We're going to talk about regulated products, which I think is really exciting because, in my view, this is where the crypto market is going. And we have a really impressive group of folks to talk about that today. So maybe just to start with, everyone, if you could just give a quick intro about you and your firm.
Sure. So I'm Hany Rashwan. I'm with Amun. We're a Swiss-based issuer of exchange-traded products. We listed the world's first crypto index on the Swiss Stock Exchange and have followed up with 5 additional products. And we also help third parties, including Bitwise, Signum, Bitcoin Suisse, launch their own ETPs off of our platform as well.
Great. Tim McCourt. I'm Global Head of Equity Index and Alternative Investment Products at the CME Group. So what we do is my team looks after the equity benchmarks such as the S&P 500, NASDAQ, and Russell, and also alternative products at CME, which include commodity indices and cryptocurrency. And we were first kind of involved in the cryptocurrency space by introducing with our partner Crypto Facilities the CME CF Bitcoin Reference Rate and Real-Time Index back in 2016, the Bitcoin Futures launch at CME in 2017, and a recent announcement around options coming on Bitcoin Futures early next year. So we're excited to be here. I think it's a great event, and thanks for everyone for joining the conversation today.
I'm Kari Larsen. I'm a partner in Perkins Coie's New York office. Perkins Coie is a firm that's been around over 100 years, has a particular focus on technology. Our group started working with blockchain technology and DLT in 2011, formally started our blockchain group in 2013. We have over 70 people in the blockchain group now that handle all kinds of issues from litigation to tax and compensation to technology and regulatory. I'm a commodities lawyer. I got into the crypto space in 2013, and my practice focuses primarily now on cryptocurrencies and DLT-based platforms.
I'm Teddy Fusaro. I'm the Chief Operating Officer at Bitwise Asset Management. My background is primarily in newer and novel types of exchange-traded funds, most recently hedge fund replication strategies and self-indexing at a firm called Index IQ that was sold to New York Life Investment Management. Prior to that, was involved in another early stage ETF issuer where we were one of the early firms that got approval to list and offer leveraged and inverse ETFs. And before that, I spent a few years at Goldman Sachs. At Bitwise, we are leaders in index and beta-based private funds that we right now just offer to accredited investors under Reg D exemptions. We also have an index business, as Hany mentioned, where we calculate, disseminate, distribute, and license indexes and index data. Our flagship private fund is benchmarked to the Bitwise 10 index, which is an index of the 10 largest crypto assets. And we're also, maybe a little bit more publicly, we're also one of the applicants in the US who is working with the SEC on a Bitcoin ETF application. We've been working with them for the past year and a half or so on this, and that's a major initiative for Bitwise's future.
Great. And I'm Peter Johnson. I'm a principal with Jump Capital. I lead our fintech and crypto investments. We're one of the largest and most active venture capital firms in the middle part of the country. We're also associated with Jump Trading, which is a very large crypto trader, market maker, and a OTC participant in the market, as well as a venture investor through my group. So we're very active in both the regulated and unregulated or spot products. So Kari, I'll start with you. And with the basic question, why regulated products? Investors right now, they can buy Bitcoin, they can buy Ethereum on spot exchanges. Mm-hmm. Why do we need anything more than that? Why is there all this interest in these different regulated products?
So I think a few reasons. I think the general reason for why people are interested in regulated products, which is the transparency, the stringency, the requirements placed on them by their regulators that provide customer protection, customer information, and security. So that's in a general sense. In the specific sense, I think it's seen as part of the maturation expansion of the market, providing liquidity to the market, allowing players that don't want to have the risk of holding their own cryptocurrencies and figuring out how to keep them secure and how to custody them and have it with a regulated, either with a regulated entity or in an ETF and not have to touch the asset at all and still be able to get exposure to it. There's also, for a number of significant players in the financial markets, they have requirements of having certain standards for what they can and cannot trade, and unregulated spot markets don't meet those requirements.
And Tim, the CME products have certainly seen significant volumes and success. Why do you think that is? What's attracting folks to those products instead of the spot products?
I think it's a good question, and I think to kind of piggyback off the attractiveness of regulated venues is we introduced the Bitcoin futures in response to articulated customer demand because they wanted a regulated product. They wanted to access the market in a regulated fashion at a tried and tested institution, I think, as such as CME. And it's not only the security, I think, that people have in transacting an essentially cleared product or something that's listed on a regulated DCM or futures exchange, but I think it's also, it removes some of those barriers to entry. It makes it easier for them to access the market if it works in a way that plugs and plays with existing infrastructure. And I think that's been one of the reasons for the growth at CME. So when we introduced the contract back in December of 2017, we were doing about 1,000 futures contracts a day, worth about 5,000 Bitcoin. Volumes ebbs and flows. We're doing about 7,000 contracts a day this year, with the equivalent of about 35,000 Bitcoin per day. And I think one of the reasons why we've grown is because we designed the product in response to the customer demand, and it worked in such a way that they were accustomed to. It functionally works the same as trading an S&P 500 future or an interest rate future. It plugs and plays with the existing network effect that they have in place. That's brought together multiple personas from the marketplace. We have your active individual traders. We have your proprietary trading firms. We have hedge funds. We have CTAs. We have institutions, whether they are crypto only in focus or more traditional in focus, and such as asset managers. So bringing together the confluence of these customer personalities and personas in a way that it was easy for them to trade and access something as new and exciting as Bitcoin, I think is what helped our volume grow over the last 2 years.
Mm-hmm. And then you also just recently announced the CME did options on futures. What's the gap in the market that you're looking to solve with that product?
It's another, like I also said, we just last Friday announced in Q1 of 2020, we're going to be introducing options on Bitcoin futures at CME, offering a regulated product with respect to nonlinear or option-based exposure. And again, this is in response to customer demand. Ever since we launched Bitcoin futures back in December of 2017, the number one request we've gotten from customers are options. When we think about futures, they provide access to the market. It's sort of linear or bilateral exposure to the upside and downside. But options provide the ability for users to manage risk very precisely. It's a risk management tool. It's not just an access tool, so they could hedge certain things with respect to their operations if they're a miner, for example, or if they are holding the digital asset or active in the spot market, they could hedge certain downside or upside scenarios in a way that they want. So options really has been requested across the board from all various aspects of customers because they want that additional precision for risk management. And now, given the robustness and the growth of the futures that I just articulated, now makes a great time for us to bring that product to market, because it's not about just whether or not you have the demand. We want to make sure ex post that product launching, it can be viable for the long run and actually service the articulated risk management need. And now with the growth of the futures, options is the next logical step, and we're happy to bring it to market.
That's great. And Hany, you take a little bit different approach to regulated products. Can you talk about what products you're dealing with and the benefit of those products?
Sure. So we deal primarily with crypto exchange traded products. Our viewpoint was that this is primarily an international market, and we were looking for a regulated, reputable, highly liquid, professional exchange from which we could build these things on top of. So we visited with 27 different countries around the world, jurisdictions around the world, before settling and choosing the Swiss Stock Exchange because of an immense amount of regulatory buy-in. What we find out is that in Switzerland, we're available for retail and institutional. Outside, it's primarily an institutional product. But what we find is that when you make crypto as easy as buying a share, then you can talk about the wider asset class. And certain investors whose mandates could preclude them from investing in non-securities or have a discomfort around dealing with the asset directly and not having things like custody being taken care of. Having this fit within their same model, their same interactive brokers account with all their other equities, bonds, fixed income, what have you. That's been a tremendous ability to push it forward. And then lastly, we also have a number of index products, baskets of top 5, top whatever, thematics are coming up. And those will be significantly harder for an individual investor to keep up with and do the rebalances, et cetera. And so you abstract all that away, you take care of that on behalf of the end user, and then you give them a reputable box within a reputable jurisdiction in order to do that. And that's sort of what we've been focusing on a lot.
Mm-hmm. And Teddy, Bitwise has been very vocal on a US regulated ETF. Why do we need a US regulated ETF? And 2, why has it been so hard to get one approved?
Yeah. So the first question is sort of more of a philosophical one, and we actually have debates, I think, with some of the members of the community who ask that same question. So in some ways, it's actually more interesting to talk about versus the second one. But what we think it comes down to is investors should have freedom of choice. And investors should be able to go to any exchange platform that they want, that they find online. They should be able to buy Bitcoin and other cryptocurrencies there. They should be able to store it there. They should be able to store it on their own. They should be able to use their own custody solutions. They should be able to select from custody providers. But they should also have the option to buy it in a registered, regulated, transparent format in their brokerage account from a provider that has professional expertise in managing exchange-traded funds, that has to go through the robust regulatory process that exists. And for some investors, that's what they want. For others, as Kari mentioned, that's what they need. For many, it'll just be what they're comfortable with or how they manage their business. For example, financial advisors, it's very difficult for financial advisors to put their clients into cryptocurrencies because they run a business that's efficient and they need to focus on raising assets and managing portfolios. Trying to figure out a new way to access an entirely different asset class is something that's very challenging for them. And we do have financial advisors, and you do see financial advisors who invest in private placements and other alternatives, obviously. But in order to make, I think, digital assets, Bitcoin in particular, available to all users who want to use it the way that they want to, we think that they should have that freedom to choose how they want to access it. So I think that's our view on why we need an ETF, on why it's taken so long. So a funny bit of regulatory news today. The SEC just today just announced the approval of their new ETF rule. The ETFs have been getting granted what's called exemptive relief since 1992. Over 300 different specific, unique, separate exemptive orders have been given to would-be ETF filers since then. What that means is, before today, before this rule goes into effect, if you wanted to issue exchange-traded funds, you need to go to the SEC and you need to say, we want certain specific exemptions from the 1940 Act in order to list our ETF shares on an exchange. So it's taken since 1992 for the commission to put together a blanket rule that all investment advisors could go forward with to be able to launch ETFs in a unified format. That's the type of time frame that we're talking about in terms of not just ETFs, but the regulatory machinations in general, right? As it relates specifically to the Bitcoin ETF, I think that we expected going in and continue to expect that it's a long process. Leveraged and inverse ETFs took about 6 years to get approved initially. But if you look at where we are now, this has now been going on for about 6 years, right? Cameron and Tyler Winklevoss had their initial application in 2013. The most notable sort of process point to date has been the rejection of that Winklevoss ETF, which occurred in the summer of 2018. That's the basis for the most material that we have for understanding how the regulator wants to deal with the issues that they need solved before we can get an ETF approved. So that's what we've been working on for the past year and a half or so, is answering the questions that they raised in that specific order. And I think the industry response has also been remarkable. We've had, I think, 15 or so comment letters on the public filing from different players in the ETF ecosystem, from people like Coinbase Custody, Tagomi, OmniX, et cetera, Cole Freeman Mallon. So that's been a positive thing. And I think what it will take eventually for an ETF to get approved is the development of a lot of things that we're going to talk about on the panel today, which is more regulated exchange activity, more regulated products, more market surveillance. The custody has been another issue that they've been concerned with. I think as Sam mentioned a few minutes ago, we feel very confident that is, if it's not all the way there, it's very, very close. We think it's a solved problem effectively. So without going into a little bit more detail, I want to leave it there and see how the conversation develops.
Yeah, and what is, I agree with you and with Bitwise that an ETF is very important for the market and it's going to bring a lot of participants in. If you had to make a projection now on when we will see an ETF available, what would you project?
Yeah, I'm going to be cautious on this one, and we do have an active S1 registration statement, and you do need to be a little bit careful. But I will say, my view, our view, and the view of a number of the commissioners at the SEC is that there will be an ETF. There will be a Bitcoin ETF, but I don't know when. The questions they've asked, our view is that they're actually really good questions. We think they're the right questions, they're important questions. We don't think that, there's something of a view, I think, in some crypto communities that the SEC doesn't know what they're asking, or they're not asking the right questions. Our view is not that. We think they're asking the right questions. And we think that really significant progress has been made towards answering those questions. How much progress? Can I put a percentage on it? No, I don't know. I don't know when.
How about the rest of the group? Does anybody have a projection on when we might see a Bitcoin ETF? Kari?
No, it's very hard to say. I mean, I think that I agree with everything that you said, that there's been significant progress. I think that the SEC is a very, very cautious regulator because they are concerned about protecting America's trillion-dollar capital markets, and they're very focused on mom and pop, the retail customers. That's their concern. I'm of course biased to the CFTC. I see it as very progressive and works faster, but its mandate is different, and the players in the market are different, and they're thinking more ahead for products, sophisticated products for people that are already comfortable with those sophisticated products. So I think, number one, they're going to need more data from the regulated products that we have in the US. I think that a year is insufficient for them. I think that they're still wrestling with custody internally. I'm hoping it's a solved problem, but there's a ton of broker-dealers talking to FINRA every day about when they can get clarity for their custody. And valuation, I think, is still an issue. So these are complicated issues, but I take real comfort in that we have industry experts, people with real depth of knowledge of the technology and the products, talking to the SEC daily and bringing them along, and regulators talking, because I think that the perspective of the CFTC, they started their education years and years ago. They had their first case. They were looking at a crypto and people, not properly being registered or committing fraud way back starting in 2013. And so they've had longer runway for education, and the SEC has, is a more recent entrant looking at it. So it's a little bit rough to look at them and say, you should really get this and get your arms around it and be comfortable going to the public in 3 years. Like, what's your holdup?
Yeah, I think the thing I would add, right, is I don't know when, right, and I certainly won't place a guess, but I think what's clear is that when it happens, I think it will be a true catalytic event for the ecosystem. So at CME, even when we were designing our future, we did it in such a way that it could be supportive of the ETF process. My background is an equity index trader, and I am highly I'm a strong believer and highly encouraged by the interrelated aspects and the convergence that happens between ETFs, futures, the underlying spot market, OTC market. So we want to be thoughtful about how can we all design products such that it is additive to the ecosystem. Whether our future, which is financially settled, can be the creation unit or underlying ETF, or design it in such a way that through the Bitcoin reference rate that our future overlies, that there is the opportunity to converge between the spot market so people can move between the various liquidity pools. These things aren't done on accident. So I think as long as those of us in the regulated space and are designing the products, we do have a responsibility to make sure we're applying the right foresight to our product development such that the ecosystem can blossom and continue to thrive. It may take a long time, but I think we need to be cognizant of the way we're introducing products now, because this interrelated aspects of the various liquidity pools is essential for the long-term growth of any product, I think, in this space.
Absolutely.
I run regulated products. I can provide a timeline or an estimate for when the Securities and Exchange Commission will allow this. However, we do speak with regulators quite often around the world. We're very interested in bringing access to the crypto asset class to anywhere where we're able to work with regulators. I think one of the points that was brought up was the mandate of the SEC, and I think that's often overlooked. The focus on mom and pop and retail investors is a really significant one. And they're just doing their jobs based on their mandate. So it will be accepted and approved once the market and the ecosystem is there, and it's not quite there yet, is what I think the evidence shows. One thing that I would add, though, is that I think it is absolutely an inflection point. I think it is absolutely going to be very important for the ecosystem, for the asset class. I don't think it's this be-all, end-all. We get a lot of material on crypto Twitter, or some of the news that we see around this seems to think that, oh, we just need the Bitcoin ETF to be approved, and then that's the next bull run, and that's 100K or 50K or whatever the thing is. I think it's part of several different things, along with transaction volume, along with the ecosystem plays that we're talking about, along with all of the things that are happening on all these new networks and new blockchains. Absolutely a major development. I think the effects of it are not going to be the victory flag on top of the hill.
Yeah, I agree. I think the ETF will be a big inflection point for the industry.
Absolutely.
So maybe to continue to pull on that string just a little bit more, like as we go more towards regulated products, we have ETFs, which opens it up for a lot of investors to invest in a way they're very familiar with. Futures products, options products. Over time, what happens to the underlying spot markets? We have so many spot exchanges right now, and I'll open this up to anybody. What happens to that market as we move to an increasingly, market that's driven by regulated products?
I think the best way of looking at this is through the lens of history with what happened with commodities. Right, there is a very healthy physical trading of the largest store of value through commodities, gold, and there are a number of abstractions across ETFs and options and derivatives and a whole slew of things as well. And I think that there's further, there's some infrastructural plays that happen with gold that we still are missing a bit in crypto. So, for example, gold has the London gold fix. Right, and that's the price determined by this method that may or may not be the best method, but it's just what's accepted by the market. We're still developing those kinds of standards and those kinds of activities within the crypto world. And so I think that if you were to compare it to anything in history, then you'd be able to look at sort of what happened in commodities, which I think is the closest thing to the model. And in Switzerland, our products are called exchange-traded products, which is actually what the Swiss call exchange-traded commodities. So our products, in fact, are based off of a physically backed Swiss custody gold product. It's same exact structure, same exact collateralization and background. So I think there's very direct parallels that I would draw between those two asset classes.
I completely agree. I think if you look at the history, I would say, depending upon the characteristics, of course, not security tokens or things like that, but generally speaking, cryptocurrencies are considered commodities. The CFTC considers them commodities. And their progression is aligned with commodities. And there have been new commodities in the last few decades. Renewable energy certificates, emission allowances, things like that, very similar, created and physically delivered, but in the ether on a registry. And the market for those have followed a very similar path, where first it was only the industry players that were in it. The early philosophical adopters who believed in the purpose, and it was a very small market, just utility to utility, and then more participants became involved, and there became spot markets. Enron traded these things, created a platform, and then you had investment banks and other kind of financial services participating in it, and then there became multiple markets where states and voluntary programs and other things started prompting it, and then you got futures products and derivatives products and options products. It moves along a very standard path, and cryptocurrency is following that same path.
Yeah, and I think they're like I said before, I think they're all interrelated. So I don't think the advent or the proliferation of the more structured products or derivatives or ETFs is an either-or decision versus the spot market. There are different reasons why different participants avail themselves to the different product choices, and as long as one can freely, or a participant in the market can freely move between them such that they are trading in line, again, this kind of, they either converge or you can substitute one for the other amongst the liquidity pool, that's still the spot market will always, in markets, provide a service. I think the question, as these things mature, is how much risk is being traded in which venue. And when you look at some futures market, there are often times where the futures market becomes larger than the spot market and things like that, but I think it's still too early to tell in the crypto space. But I think if we look back decades and centuries, there are very healthy derivative and spot markets that exist in a symbiotic fashion.
Everything's been covered. I agree with everything we've discussed in the panel. One thing I would add that's unique about Bitcoin and some other crypto assets, I don't expect it to ever fully lose its sort of original DNA, right? The concept of self-sovereignty, the concept of being able to store your own Bitcoin on an asset or memorize your seed or transfer wealth across borders in a way that was not possible before, given the technology that existed for wealth transfer, store of value, monetary systems, et cetera. There's always, in my view of the future, there's always going to be that piece of the spot market that exists, and that's part of what makes Bitcoin, I think, unique, both as a monetary system, as a technology, as a store of value. So I think that these two things, I think, exist together, though. And some of this goes to the debate about why do you need an ETF in general. Some people have a hard time squaring those two things. But I don't think it's all that different from what you see in the gold markets or for other precious metals, where a lot of people want to store their own gold in their own vaults or in their own basements or in their own underground layers. This is part of, I think, a way that some individuals just have of interacting with their idea of what it means to store wealth, or what it means to have wealth, or what it means to sort of protect their wealth into the future.
And we've been talking a lot about kind of U.S. regulation here on futures products and U.S. ETFs. There's a lot of differences in different geographies based on what's allowed, what people are interested in. I know a lot of you operate in various countries. Maybe, Kari, start with you. What are you seeing in different countries? What is what is regulation and investor preferences? How is that driving differences in what's available and what people are investing in?
So I think that from a regulated product standpoint, it's a little bit. So people tend to think in the crypto world like there's no regulation and then there's the U.S. That's not the case. So every jurisdiction has its own regulation, particularly with respect to derivatives and securities products, and it's very distinctive for each one. But there's been commitments, for example, for trading and clearing methods for derivatives amongst the G20. There's international agreements. So there's certain standards that are held, across the world. And that being said, though, the U.S. does have a particularly aggressive view about when their jurisdiction applies. And there's also questions of what is a derivative. For example, some jurisdictions would go after physically settled things, and other jurisdictions find if it's settled in cryptocurrency, then it doesn't fall into the derivatives platform and is not subject to regulation. And then there's other jurisdictions that just are very minimal in what they require. And so, and then the US, if it's one US customer, done. And that is a US citizen that is resident abroad or a non-US person who is living in the US. It's a very, and from the CFTC, if things affect US markets, they will claim jurisdiction. So it is an extremely broad view, and other jurisdictions have a much more narrow view about what would actually trigger their regulatory regime. So what we are seeing is sort of the, like decentralized exchanges and some other products being, initiated, begun, launched non-US, and getting liquidity and getting volume and attracting attention in non-US platforms, both regulated and unregulated. And they don't allow US customers, going back to one of the earlier panels where they talked about that issue and how it's being reconciled, and particularly if you look at the agreements where they also say no US beneficial owners, and so that's probably being violated left and right with a lot of the derivatives exchanges out there, derivatives products. But there's definitely this perception that you start non-US and build to US, or just exclude the US at all, except not really.
I think one of the most interesting things about the background of your question is the kinds of products that are created and the kinds of innovations that happen based on the geography. Because exchange-traded products are actually quite popular in Europe. There are a couple of issuers, including ourselves, and there are more that I'm sure are coming. DeFi products are particularly popular, and they start sprouting up in Asia. And perhaps that has something to do with how some of the more financial structures in Asia have been struck down, right? There have not been as many futures, options, or ETPs in Asia, and that sort of pushes you into a corner maybe where DeFi might be much more attractive. In the US, I'd say we have an extremely healthy futures market and extremely healthy structured products, funds, etc. And so I think the most fascinating part about this is that it also forces the entrepreneurs and the companies on a local level to do different things. And the biggest case of this has been Binance. It also, if you're a company that is willing to, take some risks and do regulatory arbitrage, you can also create different products in different jurisdictions in different ways, which is truly fascinating. I think something that's been fairly unique in the crypto world.
Yeah, I think maybe just one thing that I would add, my view and Bitwise's view has been more constructive about the dialogue we've had with the regulators than I think the industry standard. We actually think that they've been helpful in offering the guidance for what it is we're specifically trying to do, and answering the right questions that we think need to be asked to do what it is that we need to do. But I do think there's risk in the pace of regulatory innovation that we're starting to see just by the way that we're having this conversation. Think about Hany's business. It talked to 27 different jurisdictions, decided to set up in Switzerland. There's a national competitiveness issue that needs to be confronted in DC, which is that we don't want all of the development in this ecosystem, in this industry, to occur in Singapore and in Switzerland and in Ireland. That's not what the United States should want, right? We should want to have sensible regulation, have clear regulation, have standards that people can abide by and understand, and hopefully have that innovation take place in the States. The thing that is a risk right now is that many entrepreneurs are taking a look at what it is you can and can't do here and saying, I can't figure out a way to deal with this.
I don't want to pay for it.
And exactly, that's what I was just going to say. Maybe they don't have the access to the types of lawyers or the budget for the types of lawyers that you need. I mean, one of the things that we always talk to entrepreneurs who are getting into this space is don't do anything without a good lawyer. And if you're in San Francisco and you have a seed stage company or a few angel investors, like the thing that they don't want to hear is, well, I'm going to take half of it and go spend it on a good lawyer. That's a really challenging cross current, and that's something that the United States does need to figure out. I actually, I'm a little bit more positive on it now than I was a year ago. I think that the Libra conversation, the dialogue with Facebook's Libra idea is actually dragging the conversation upstream a little bit. So I'm hopeful that we'll see some real movement.
I would go a step further and say I think the Libra conversation has been amazing in that it has dragged the entire G20 forward. Right? That you had so many countries that just absolutely forgot about it, did not deal with it, and then had to have a reaction, and that's been very positive. And obviously, to Teddy's point, despite my American accent, I live in Zurich for a reason. I think it's obvious who the first regulators that we tried to speak to were, but we could really only do this in a handful of places, and that's a huge part of it, and I'm sure we're not the only ones.
Yeah, I would echo that. And what we're seeing as investors in early stage companies, it's tough in the U.S. Because you have to have good lawyers, which are expensive if you're playing in the. But
I think the other thing, right, especially in crypto, and kind of going back to the first question, is I think a lot of times when the topic of regulation comes up in crypto, it's through the lens of this is trying to somehow stymie growth or kill Bitcoin, or the governments don't want this thing to happen. But I actually think the opposite is quite true. Obviously, we're a regulated venue, so I may have a different perspective, but one of the benefits of answering and going through this growing process with respect to regulation is it makes it very easy after the fact to understand what the rules of the road are. And regulation, and going back to, there are certain market participants that want to get involved but can't get involved if it's not regulated. So working on the regulations and kind of making sure the regulations keep pace with the innovation actually will help lower barriers to entry, which I only see as a good thing for the long run. So there may be some short-term pain as things are catching up, and it may not be happening as quickly or kind of on crypto time that people want. But if you think of a long-term health of a market that will be around for like decades and generations, that's kind of the investment that's being made now, and I think that's what actually helps things in terms of lowering barriers, increasing adoption, because it does increase transparency with respect to rules of the road, such that people can make decisions for the long term and know how the system will react in various scenarios.
I think that's a good point. I know we're running out of time. Is there any questions from the audience?
I think this one.
So, over there?
This is a CME question. Apart from day traders, who actually holds your futures? Like, is it miners? Is it purely speculators? Like, what type of people?
Sure. So, I mean, we don't necessarily get into the specifics of who's holding the contract, but a great place to look is the CFTC Commitment of Traders report. So one of the things that we track is referred to large traders or large open interest holders, and those are those individuals that hold more than 25 futures contracts. That number reached 56 in July, which is the current record, and those holders are not necessarily, I mean, as the name would suggest, they're not necessarily day traders, because day traders don't typically hold positions overnight. They're trading firms, they're hedge funds, they're CTAs, they're retail, and some of the proprietary trading firms and market makers are holding positions against other spot digital assets. So it's really dispersed across that. But if you look, and you can go to the CME website, we have a more visually easy to digest tool. It will show it, but they break it down into dealers, leveraged, other, and I think asset managers. But you can see the trends, but it doesn't get any more granular than that.
Good.
Question for Teddy. How does today's ruling from the SEC about blanket exemptions for ETFs, how does that affect the process for the Bitcoin ETF?
Yeah, great question, KJ. It actually doesn't. I raise it because it shows just the sort of the time frames that we're working on here and the expectations that we should all have about how, particularly with these mass adoption retail products, how cautious they are. Today's ruling sort of changed made uniform the different rules that ETF issuers need to abide by, with things like what you have to publish publicly, how frequently, what you can accept in kind for creations and redemptions in the transaction process. but it actually doesn't directly impact the proposed Bitwise Bitcoin ETF. And sort of ironically also, our exchange-traded product as proposed is not a 1940 Act fund, it's a 1933 Act publicly traded trust. So it's a little bit different than the traditional pathway that would be used for an exchange-traded fund. Structured very similarly to GLD, which is the popular gold ETF.
All right, well with that, I think we're out of time. Thank you very much for our panelists. It was excellent.